Hey, good afternoon, everyone. Chris Dime here. I'm a certified financial planner out of Edmonds, Washington. I specialize in working with folks to and through retirement. Today, I thought it'd be helpful to cover how your Social Security benefits are taxed, how to do a calculation to figure out how much of it is taxable, as well as to cover some strategies on how to reduce the tax burden of your Social Security benefits. If you didn't know your Social Security benefits are subject to income tax, this is probably going to be a helpful video for you. Depending on how much money you report as taxable income in retirement, your Social Security benefits are also taxable. To keep it simple, the more money you make in retirement, the more money you'll pay in taxes on your Social Security benefits. So to determine how much of your Social Security benefits are taxable or are subject to income tax, you're going to want to figure out how much of provisional income you have, also known as combined income. This is actually just a colloquial term that's used by advisors and tax professionals. The Internal Revenue Code doesn't actually say provisional income is calculated this way. It's mostly just all your taxable income sources plus half of your Social Security benefits. The income tax treatment of your Social Security benefits is described in the Internal Revenue Code section 83. And actually between 1937 and 1983, Social Security benefits received in retirement weren't taxable. And 1937 was when the first Social Security benefit payment was made. And in 1983, there was some legislation implemented that essentially boiled down to the IRS realizing that people that didn't need these benefits as much as originally thought were kind of benefiting from the system. So how do you disincentivize that, or how do you collect some tax revenue on that? You tax the Social Security benefits. So the first 50% tax bracket on Social Security benefits was implemented. And then later in 1993, a second bracket of 85% was implemented. Now, to clarify, I'm not saying the tax on your Social Security benefits is 50% or 85%. We'll jump into exactly how these brackets apply, but it's not 85% of your Social Security benefits are going to be sent back to the IRS in the way of taxes. There are some representatives who are gunning for getting rid of this entire Social Security benefit taxation rule, specifically Angie Craig out of Minnesota. She's putting forth some legislation trying to get it pushed through that says, hey, let's get rid of taxing people on the benefits. And the concept there is you've paid taxes to contribute money to this program, therefore it's been funded with after-tax dollars. So any benefits received, just like Roth money, should be tax-free on the way out. That's not how it works with Social Security benefits, so some folks are fighting to bring it back to the way it was between 1937 and 1983. I have a hard time thinking that that's going to pass anytime soon, so if I were you and I was planning ahead for your retirement, even if you're in your 20s, I would plan on your Social Security benefits being considered taxable income to some degree. Maybe not at these exact brackets, but to some degree. Probably even worse. So how do you figure out how much you will owe? Well, we go back to first figuring out how much in provisional income or combined income you have. To start the calculation, if you're currently in retirement and receiving Social Security benefits, you'd want to get a copy of your SS 1099. You can go online and get a copy of that, but essentially that's how much money the Social Security Department has paid you in Social Security benefits. That's going to come into play because we're going to take half of that benefit and add it to the rest of all your other income sources to determine your provisional or combined income. Once you've calculated your provisional or combined income, or you're estimating future provisional or combined income numbers, you're then going to take that number, you're going to apply it to this bracket. And then depending on where your number lies on this bracket, that's going to dictate how much of your Social Security benefits are going to be includable in taxable income for the remainder of your tax return, where you go on to figure out your adjusted gross income, your total taxable income, and you're going to pay some income taxes on that number. Let's go over a quick example to make this a little bit more clear. There's two different brackets. There's married filing jointly and single. We're just going to use married filing jointly for these examples. If you're single, just reduce the numbers and the math still applies the exact same way. Let's say we have a couple in retirement named Chris and Kayla, and they are withdrawing Social Security benefits at this time. And let's just keep it super simple and say 30 grand is coming from Chris, 30 grand is coming from Kayla for a combined Social Security benefit of 60 grand a year. Then let's say they're pulling 40 grand a year in pre-tax IRA distributions. So they need 100 grand every year to pay all their bills. Very simple. 60 grand from Social Security, 40 grand from their traditional IRA. That combined is $100,000. But that's not their provisional or combined income. Their provisional or combined income is the IRA distribution, 40 grand, plus half of the Social Security benefits. And the Social Security benefits were 60, so half that's 30. So you take 30 plus the 40 grand IRA distribution, you combine that together, and that's how you get 70 grand in combined income or provisional income. We can use that $70,000 number and apply it to these brackets over here to figure out how much of the 60 grand Social Security benefits are included in taxable income. So looking at the brackets, the first 32 grand of the provisional income is not factored into the calculation. So we can remove that off the table immediately. The next 12 grand is includable up to 50%. So if they have a provisional income of 70 grand, the first 32 is not included in the calculation. Then the next 12 grand is included in the calculation, but only 50% of that, which is 6 grand. So we'll put that number over here for a second, 6 grand. Remember again, they had 70 grand of total combined income. We've gotten rid of the first 32,000, then we got rid of the next 12,000. So the remaining 26,000 is all that's left. And according to these brackets, the next 26,000 is included up to 85%. So 85% of that 26,000 is 22,100. So we've got 22,100 is includable as well. So we'll take 6 grand plus 22,100. We'll add that together and we'll get a total amount of Social Security benefits that are included in taxable income of 28,100. Let's run through another example. Same couple, Chris and Kayla, but in this scenario, let's say instead of earning 60 grand in Social Security benefits, they earn 40 grand in Social Security benefits. Again, we'll keep it simple. We'll say it's 20 from Kayla, 20 from Chris. So a total of 40 grand in Social Security benefits. Then let's say they pull 20 grand a year in IRA distributions for a total income of 60 grand a year to pay all their bills. But remember, that's not their provisional income. Their provisional income is the $20,000 IRA contribution plus half of their Social Security benefits. Half of their $40,000 Social Security benefits will be $20,000. So you take $20,000 plus $20,000 equals $40,000 of combined income or provisional income. Now we take that provisional income and we run it back through those brackets again. Remember, the first $32,000 of the 40 grand of provisional income is not included in the calculation. So we get rid of that. That leaves a remainder of $8,000. We run that into the tables. $8,000 falls between that 50% bracket. So 50% of that 8 grand is included in our calculation. And 50% of 8 grand is 4 grand. So we've got 4 grand over there. That actually completely exhausts all the combined income when we run it through the tables. AKA, there's none of their provisional income that would fall into that 85% bracket. And so that 4 grand over there is the only amount of their Social Security benefits that they need to include as part of their taxable income. The rest is considered tax-free income. Therefore, out of the 40 grand in total Social Security benefits they're receiving, only 4 grand is included in taxable income. So between the two families, 4 grand for the second scenario and 21,100 in the first scenario, obviously the 21,100 is a lot more of a Social Security benefit that's included in taxable income. So that's something to consider when you're doing your planning, is your Social Security benefits might not all be tax-free, and it really depends on your total provisional income to determine how much of that is going to be considered tax-free or taxable. So if you don't like that your Social Security benefits are going to be taxable in retirement, what are some strategies to reduce that burden or decrease the likelihood that a lot of your benefits will be included in taxable income? Well, simply put, anything that contributes to your taxable income is not going to help you reduce your total provisional income or combined income. There's a few things you can do ahead of your Social Security to set you up for success. Let's take pensions, for example. If you plan on getting a pension of some kind in retirement, you usually have distribution options when you're getting ready to pull the trigger on receiving those pension benefits. You can receive a single life benefit. That's a high benefit with no remainder left if you were to predecease your spouse. Or you can opt for a more liberal beneficiary plan, also known as like a 100% joint and survivor benefit, where you take a lower pension payment, but if you die, your spouse receives that same amount for the rest of their life. When you think about it from a provisional income standpoint, that would decrease how much every year you have to report as taxable income coming from sources outside of your Social Security benefits. That would decrease your provisional income. So it's something to consider. Obviously, there's more to it than letting the provisional income tail wag the pension dog, but you'd still want to figure out, okay, if I do a single life benefit, how is that going to affect my provisional income? Versus if I do a joint and survivor benefit, how much is that going to affect my provisional income? Could be a factor in play as to which distribution option you choose. A second thing to think about are medical expenses. Most of the time we see very reactive financial planning is to just take money out of their IRA whenever they need to pay a bill or something to that effect. And while if that's your only option, obviously you gotta do what you gotta do to pay your bills. One thing you can start doing ahead of time is accumulate money inside of an HSA to pay medical expenses that you know you're probably gonna have in retirement. As a quick refresher, any money that comes out of your HSA is not considered taxable income if you use it to pay for medical expenses. And so one way to get rid of drawing money out of your IRA, which bumps up your taxable income, is to take money out of the HSA instead to pay medical expenses. That keeps your taxable income exactly where it was before the HSA distribution. A super simple way to reduce your provisional income in retirement is instead of taking from a pre-tax IRA That's going to be a fully taxable distribution. You pull from a Roth IRA, which is completely tax-free. Obviously, you need to prepare ahead of time by either funding a Roth directly or doing some Roth conversions before you file for Social Security, but something to consider as you think about your long-term retirement planning. Your provisional income thresholds might also play a role in dictating how large of Roth conversions you do throughout your retirement so that you don't push yourself up into too high of a provisional income tax bracket. Similar to marginal tax brackets, maybe you try to stay within a certain threshold for the length of your retirement, doing itty-bitty Roth conversions over that time, if putting more money into Roth is advantageous for you. From an investment planning standpoint, there's a couple of options you have. For anybody that has a joint investment account or taxable investment account or concentrated stock trading investment account, that's not a qualified retirement plan. Rather than treating it like normally where you get capital gains and losses, and ideally you have more gains and losses at the end of the year, you might want to look into tax loss harvesting. Tax loss harvesting is essentially where you change around some of the positions in your portfolio that don't materially impact the diversification of your plan, but they do allow you to capture losses. When the markets are very volatile, like recently, where the market drops, rather than changing your portfolio in its entirety, you can make a simple swap from, one ETF or one stock position to another similar type of program. But by doing that switch, you capitalize on that loss. You can then harvest that loss and you can offset future gains. If ever you need money from your account and you don't want to realize gains at that point, you could recognize a gain and then use a loss from previous years to offset that gain, and therefore it won't contribute to your taxable income. Another investment strategy to reduce the impact on your provisional income is to look into asset location. So asset location, it's a little different than asset allocation, where let's say you have a retirement account and you have a non-retirement account. The non-retirement account, any income received in that account, you're gonna have to pay ordinary income tax. That's gonna bump up your taxable income. Any income you receive inside your retirement plan, you don't pay any income taxes on because it's all tax deferred. From an asset location standpoint, let's say you wanna have 60 to 70% of your total wealth invested in stocks, 30 to 40% of your total wealth invested in bonds. Bonds usually kick off an income coupon of some kind that will increase your taxable income. So mathematically, you might look into owning all of your equities or stocks inside your non-retirement account and own all your income producing investments inside of your retirement account. It's a little challenging to do. However, what that ultimately will let you do is never sell the equities, or at least try to never sell the equities, so that you never actually generate any taxable income sources over here. And if you want to sell and do whatever over here in your qualified account, you can totally do that, because again, anything you generate for income or taxable interest inside this account is non-taxable. It's tax deferred. And so that's one way to keep your investments invested in the portfolio that's right for you, but asset locate which types of investments are held where to decrease how much your investments could affect your provisional income. Another thing to think about ahead of time is any sort of deferred compensation plan that has a mandatory withdrawal. So for example, Microsoft has a deferred compensation plan, also called the DCP, where when you reach level 67 and beyond, you get access to it. And that program has a mandatory withdrawal structure of some kind. You have a few different options of distributions, lump sum or over the next 5 years when you retire, stuff like that. And one thing to think about when it comes to your Social Security planning is it might be more advantageous to look into certain payment installations from that plan to occur before you file for Social Security, because if you can take a lump sum the year before you file for Social Security benefits, well, now your Social Security benefits provisional income won't be affected by your deferred compensation plan. Now, obviously, you'd pay a ton of taxes on that year you take a lump sum from your deferred compensation plan, so do the math. But there might be some ways in which you choose an installation plan or you choose some type of distribution method that doesn't affect your provisional income by as much. Another financial tool you could use is life insurance. So back in the day when I was with Northwestern Mutual, a lot of our financial planning was around using the cash value of life insurance plans. And life insurance plans are withdrawn cost basis first of your cash value, and so that cash value is income tax free. The gain on that is considered taxable income at ordinary income tax brackets, so you probably want to exhaust your basis first. However, if you're hurting for tax-free sources of income, one thing you consider withdrawing is the cost basis on your cash value in your life insurance. There's some other financial ways to use life insurance, such as loan provision of the cash value and things like that. Those are more advanced topics. If you have questions, you can send me an email, but at least withdrawing the basis tax-free first is an option to get income or get the ability to pay your bills without increasing your provisional income. The provisional income numbers could affect your Social Security withdrawal timing, depending on what major cash flow event or installation payments from the sale of a previous business. Those types of things could very much affect your provisional income. And so that might also influence when you decide to pull Social Security. Maybe you pull Social Security a year later than you were originally thinking because in that year there's going to be a major liquidation event and that's going to drive up your taxable income. Well, you wouldn't want to pull Social Security and have a major tax event in the same year because that'll really boost your provisional income. Not the most attractive of tax strategies. So maybe you do the liquidation event, the major tax event, and then the next year you pull your Social Security benefits. A couple other things to think about. Obviously, required minimum distributions are going to affect your provisional income. For example, if you have Social Security benefits and then you're going to pull 20 grand out of your taxable investment account to pay your bills, but you've got this massive required minimum distribution over here because you're past 72 years old, or you inherited a retirement account and you have a required minimum distribution, that's considered taxable income. That's going to boost up your adjusted gross income and that's going to affect your provisional income in a negative way. So something to think about and be cognizant of as you're looking ahead. Might be smart to look into Roth conversions ahead of filing for Social Security to decrease the impact of required minimum distributions on your provisional income. I'm sure we could do this all day, but the last strategy that immediately comes to mind are qualified charitable distributions, or QCDs. I'll push out another video on this another time, or if that's a topic you have questions on and you'd like me to accelerate a video on that, let me know. But qualified charitable distributions are essentially any distributions you have to make from your IRA. You just donate that instead of taking it as taxable income. So let's say you have a required minimum distribution of 20 grand a year, but you also want to donate 20 grand a year to your church every year. Rather than take the required minimum distribution as taxable income and then go donate that 20 grand to charity, it might make more sense to just donate to charity directly from your IRA. What does that do? Well, it satisfies the required minimum distribution. You don't have to factor it in as taxable income, and you get to donate to charity like you were planning to anyways. Your dollar goes further when you do that because you don't have to pay income taxes on the required minimum distribution, which helps the charity because they get more bang for the buck, helps you because you pay less in tax, and it definitely helps your Social Security benefits because now you have less in provisional income that you have to report. Therefore, you have less in taxes to pay on your Social Security benefits. If you can think of other strategies, drop them in the chat. I mean, I've got a list here, but I thought those were kind of like the most important ones. So now that you've surrendered to the fact that you're probably going to have to include a good portion of your Social Security benefits in your taxable income, what are some things you can do to get proactive in paying these taxes? A lot of people don't know this, but you actually can have the IRS withhold a portion of your Social Security benefits for you so that you don't get caught with any surprises in April, or you don't have to withhold more elsewhere. What you'd look for is Form W4V, which is essentially a voluntary withholding program that the IRS lets you use on your Social Security benefits. You'll have 4 withholding options. You'll have 7%, 10%, 12%, and 22%. You'd have to just pick which one you want to use. Obviously, talk with your tax professionals and your financial professionals about what you should withhold, because you're essentially hand jamming a provisional income calculation for next year and then asking the IRS to withhold a percentage of your benefits for that. On a side note, sometimes folks severely underestimate how much they'll owe in taxes each year, and you actually can get penalized from the IRS if you don't withhold enough ahead of time, aka you can't withhold nothing and then owe the IRS in April $300,000 in taxes. You'll suffer some pretty severe tax penalties for that. And so there are ways in which you can make some ad hoc tax payments to the IRS. I'll push out another video on this at some point in the future. We've ran some clients through it in the past where you make voluntary quarterly payments to the IRS based on what you're projecting your total taxes are going to be for the year. If you want the guide for how to do it step by step, just shoot me an email, we'll get it out to you. I'm also going to include some resources below, one from the Internal Revenue Code directly that helps you calculate your modified adjusted gross income. So what's your call to action? So there's 2 types of people that are going to be listening to this video, people in retirement and then people not yet in retirement. If you're in retirement, look at the aforementioned strategies earlier in the video and see if you can use any of these looking ahead to decrease the impact on provisional income in the future. Obviously, what's done is done, but we can control the future in certain aspects. And so I would look ahead and see if you can employ any of those to decrease your provisional income. The second demographic of people are those that are not currently in retirement. And for those people, same advice. Go back, look at the aforementioned strategies, see if you can proactively plan for any of those ahead of time. Roth conversions, stuff like that. Ultimately, the call to action is to speak with your financial professional and your tax professional about some strategies to decrease the provisional income on your retirement plan in the future for your Social Security benefits so that they can last longer, you can leave more to family, and pay less to the IRS. As always, if you have further questions, you can send us an email, we'll get you squared away. You can book a free consultation with us there. Speak with your tax professionals. I'm not a tax expert by any means. These are just some things I've picked up along the way. Hopefully you found the video helpful. Love to get your feedback. Have a great rest of the day. We'll talk to you later. Bye.